to it right now, and that is raising interest rates. The Federal Reserve announcing yesterday it will raise interest rates for the fourth time this year. Fed Chief Jay Powell commenting on the decision afterwards.
We have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels. At the same time, financial market volatility has increased over the past couple of months, and overall financial conditions have tightened. That is, they have become less supportive of growth. As I've mentioned, most of my colleagues expect the economy to continue to perform well in the coming year. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year.
Well, that obviously was telling. A lot of people had 3 rate hikes in the books. But look what happened after Jay Powell spoke. The Dow, the S&P 500, and the NASDAQ tumbled on the news. The Dow Industrial's down 351 points at the close, 1.5%. The NASDAQ was down better than 2%, 147 points lower. Here now, Diversified Private Wealth Advisors President Dominick Tavella and Vining Sparks Chief Economist Craig Dismuke. Good to see you both, gentlemen. Thank you so much for joining us. And Craig, when you were watching Jay Powell, you had a specific message for him yesterday. Tell us about it.
Well, I thought they needed to do 3 things yesterday, and they did the first one well. That was to hike without spooking the markets, and certainly they accomplished that. After the initial wave of data that came out, the markets weren't too spooked. They needed to transition from a mechanical pace of rate hikes to one that was less mechanical, something that was going to be very data dependent. And it felt more like, and I think they did a decent job at this, but it really felt more like they moved from quarterly hikes to semi-annual hikes. And I think that unnerved the markets. And the third thing, they needed to acknowledge the market concerns. You guys have already discussed this morning. I don't think you did a great job of that in the press conference, and that's where I think the issue was.
Yeah, that's a good point, because I'm over here questioning why wasn't the international story talked about more. And Dagan brings up, they didn't even talk about, nobody asked about fiscal policy either. And in the Journal this morning, James Freeman, the editorial board, comments on the decision in today's op-ed, writing this: Powell to markets, take that. Writing, quote, perhaps Mr. Powell and the Fed are right, but the Fed staff record over the last 10 years as an economic forecaster doesn't inspire much confidence. James.
Or the last 100 years, I guess, if we're being precise. But especially in the last 10 years, certainly really overestimated how well the economy was going to do under President Obama, underestimated how well it was going to do under President Trump. So now, with a pretty, I think you would have to say, relatively bullish outlook, you do have to wonder where the economy is going from here.
Yeah, but he said solid 2.5% in terms of growth next year. Now, you spoke yesterday, Dagan, with Macro Mavens President Stephanie Pomboy. When asked about any indications of a potential recession, she had this to say.
A much broader swath of the economy hasn't seen the type of benefit from the tax cut and this type of momentum that's reflected in the top stocks. Even in the S&P 500, the top 20% of companies accounted for 70% of the earnings growth last quarter. The bottom half of companies accounted for 9%.
So that weakening is being seen already, Dominick Tavella. Your reaction to what took place?
Murray, I think you really hit the nail on the head. That if we were sitting here a year from now and we did have a 2.5% growth in GDP, inflation stayed at 2%, we had good growth in wages with really no inflation in the economy, we'd all be thrilled, and we'd have really good corporate earnings to follow after that. The problem is no one believes the story that the Fed is spewing out there. No one believes that we're really going to grow at 2.5%. And so depending which side of this equation you're on, either we are going to grow or we're not, that's where you're going to put your stock portfolio.
Well, there are headwinds, Liz.
Yeah, there are headwinds. But I think really what also happened yesterday is when we woke up yesterday morning, the market was pricing in 1/2 of one rate hike in 2019. It wasn't pricing in 3 or 4. So the fact that they came down to 2, people just got ahead of their skis, in my view, and overly optimistic about how the Fed was going to treat some signs of slowing down. To your point, Maria, most of those are overseas. They're not in this country. But nonetheless, we went from a synchronized growth global growth experience 6 months ago, a year ago, to now kind of around the world, the United States is the bright spot. And that's a big change.
Yeah, but there's been real stress in the credit markets. There have been real liquidity problems in recent weeks. And as the Journal, which Maria was talking about, pointed out, that the statement was unanimous, and it barely changed from the one in November, despite all this anxiety in the markets. And so it is literal higher interest rates, and then the reduction of the balance sheet, the quantitative tightening. It is a 1-2 punch to the markets and the credit markets and the U.S. economy. And investors walked away from that meeting and that press conference yesterday and thought, why doesn't Jay Powell see what we see?
Why is he not acknowledging that? He did address what markets are doing. A couple of people asked him about markets in the press conference.
And he said they watched. They said
and
they were watching.
They watched them, but nothing really in terms of what the markets are telling us.
Yeah, we watch them too, but clearly more closely than you do.
Well, look, they talk about how the job of a Fed chair is to take away the punch bowl when the financial party is getting going. He seems determined to take it away even when it's not getting going. And so
we're still thirsty.
Yeah. So I would say if if you're guessing what he's thinking, it is probably, especially early in his tenure, he wants to establish the credibility that he is first and foremost a guardian of the value of the U.S. dollar and price stability. We're going to find out whether he's overdoing it, but I think you could see him wanting to set the tone now, and not just going against what the president suggested, but the 2 rate hikes next year. Certainly a hawkish message, and I think he wants to establish that belief and reputation.
The Journal does think, the editorial board, that it was a deliberate response yesterday to Donald Trump's public pleas not to raise interest rates. They said, we said Mr. Trump's bullying tweets on interest rates would be counterproductive, and so they were. So they're making that call.
Dagan, I would remind everyone, it wasn't just Donald Trump who was talking about not raising rates. It was also Stan Druckenmiller and Kevin Warsh and a whole host of people who came out in the last month.
Robert Kaplan, president of the Dallas Fed, who told me a year and a half ago to expect 1.9% growth in the end of 19.
Yeah, I mean, there were a lot of reasons you might have not raised rates yesterday. But the answer is, I think, to Jim's point, I think they really did want to sort of establish independence. And I think we also have an issue with this whole data-driven issue. What data? Is it the last 4 months data, the last 4 weeks data?
Well, he said he speaks to a lot of people, all corners of the country. He's speaking to small business, and he's looking at markets. Craig Dismuke, Dominick, Tavella, let's get your final word here. First on you, Craig, you're an economist. You've got to have models in place. What kind of growth are you looking for in 19 and 20?
19 a slowdown into the low 2% range, and then 20 back down towards 2%. We're worried that you could see some correction come at that point. Certainly, I think when you look at the Fed policy is going to affect activity 12 to 24 months from now. And when you look at that, there's going to be a slowdown already. And so that's why people are saying the Fed should go ahead and pause. And I think Warsh has been right all along. And I think that's where we need to be right now. And I think that's where the Fed missed the boat yesterday.
Dominick, you're a wealth advisor. You've got to put money to work. What do you do now as an investor?
Well, as an investor, you got to pause and you got to see what's going on. My real concern, Maria, is I'm already getting the phone calls.
Raise cash, put money on the sidelines? What does that mean? Pause.
We've already had cash sitting on the sidelines, so we're trying to figure out when and how to put it back to work. At this point, we're just not quite ready to do it yet. All right. I'm hoping after the first of the year. And Dominick, you are. Did you want to say something before I get to the Christmas Village, real quick?
Just outstanding background with Dom and the Roaring Fire and Santa, but go ahead.
Dominick, you're at the Christmas Village, and we're going to be there this morning, all morning, celebrating Christmas with carolers and Santas. So some good news there. Gentlemen, thank you for weighing in. We appreciate it. Thank you so much.